So welcome everyone who's here. This is our special call on can you 1031 into a syndication featuring attorney Nicholas Moore, who was gracious enough to join us and to talk on that subject. We get this question a lot as syndicators, so I'm so excited just to hear you kind of cover it and maybe take some questions from people that have specific things. We have some questions too. I'm Hillary Graves of Bright Sound Investments, and my co-hosts today are Jay and Tana Boersma, and I'll let them introduce themselves.
So I will introduce both of us. We are Jay and Tana Boersma. We're with Neighborhood Capital Resources. We're a multifamily operator with assets in Oklahoma and Arizona. And we're joined by Nick Moore, who I'll introduce shortly. This webinar is about investing, as Hillary said, 1031 exchange proceeds into a syndication. And hopefully we're going to learn some ins and outs and maybe pros and cons, both from the perspective of the operator or syndicator, but also that from the passive investor. And so the impetus for the timing of this webinar is that we're involved in a multifamily investment opportunity right now with Hillary, where we're raising capital. And the question keeps coming up, can I invest 1031 funds into your syndicated opportunity? And so I found myself answering the question by saying, let me find out. And so I did find out, and I talked to no fewer than 5 attorneys. And Nick is an attorney, a syndication attorney that we've used to close on 3 different properties this year. So he did syndication legal work for us on one of the deals, which was 2 properties, and he did joint venture documentation and legal work for the other deal. So we've closed with Nick this year. He's done a great job. His answer to this question was the most clear and concise of all the attorneys that I spoke with. And not only that, it was clear and concise, but it was also the answer I liked the best. So Nick's going to take over. Nick, take it away.
Certainly. Yeah. So I'm Nick Moore. I am a real estate transactional and private equity attorney. I've been fortunate enough to work with Jay and Tana on a couple of projects, as Jay alluded. And so most recently, Jay had reached out asking about tenancies in common, and as many my clients and syndicators experience, when you get out on the fundraising and capital raising trail, the question always comes up, well, can you take an exchange? And so if any of you have read offering documents, whether mine or another attorney's, presumably, it'll tell you that the LLC, that's the issuer of the security, in effect, the company into which you're making your investment, cannot accept 1031 exchanges. And that's actually true. So you can't sell a property and then take your $1 million, for example, and just take a limited partnership position in that issuer. Okay, you can't do that. It'd be nice if we could, but we can't. Okay, and so the whole purpose of the 1031 exchange is really just to get a step up in your tax basis. So you defer your gain until a later date of sale where you do realize your gain. And so in so doing, you do a like kind exchange. Not to get too granular into that today, so our eyes don't glaze over here. Really, the best litmus is that the property into which you're exchanging your funds is of equal or greater value, generally greater value than the project that you're exchanging out of. Okay, and so when that's the case, and you do have net sale proceeds, you take those proceeds and you put them with a qualified intermediary, right, or exchange agent. That third party can't be affiliated with you at all. So it's a true neutral. At that time, they hold your funds until you find an opportunity where you can take title to the property. Okay. And so people ask, well, what does that have to do with the syndication? Well, ultimately, to be able to accommodate their investment, your syndication LLC will be a tenant in common with their exchange LLC. Okay. So let's call them a tick investor. Seems to be the best word to use. Some people say tick partner, but it's funny because a tick is the tenancy in common, which is a tick. Obviously, that's the acronym for it. Is an advent of statutory law. And so just some rules that you have to follow, and you can complete it. But it's not a partnership, and it's very express about that. You can't change things like we can do in an operating agreement in a limited liability company. It's there's pretty rigid rules. But as long as you follow those rules, and they're very clear, there's no gotchas in there, then you get the benefit of avoiding the tax liability on what we call your down leg, which is just the sale of your initial property. And so ultimately, you'll have a syndication LLC, and so you can run it there. So let's say we're raising $5 million. We're going to work in round numbers today, okay? Because we don't really want to do that much math. So we have a $5 million raise that we're trying to do. We have an exchange prospect, a TIC investor who has $1 million that they're looking to invest in the deal. And so that leaves us with a net $4 million that we're trying to raise through a normal syndication exercise and program. And so our syndication LLC, whereas maybe initially we had 5,000 units at $1,000 each, okay, in that offering, now we're down to 4,000 because we only need $4 million, not $5 million. And so the syndication LLC is now going to be comprised of typically fewer members or just a lower amount of capital. Okay. And then the TIC investor is going to have their own LLC, and you're going to hold title to the subject property as tenants in common. That's going to be supported by a tenants in common agreement. And that's going to look very similar to an operating agreement. Okay. It talks about management, it talks about certain decision making that happens, certain accounting methods, et cetera, but it's going to expound on how that tenancy in common is going to be handled. And so, as you can imagine, the syndicating sponsor doesn't want to concede any authority to the TIC investor, and they don't have to and shouldn't. And so, this TIC agreement contemplates as a syndication LLC is going to be the TIC administrator. So they're going to administer everything on behalf of the tenancy in common, and work just as if they were the lead sponsor and there was no TIC. Okay. And then that TIC investor is going to have their LLC relegated to a little bit more of a subordinate position. But look, at the end of the day, that TIC investor customarily just wants to, kind of sit back and let you operate, and then collect their revenue, and their distributions as the project succeeds. Okay. And so that's the general framework. That's the setup. That's how it comes to fruition. Those are the agreements that support it. So yes, you can have a syndication. You can have somebody exchange proceeds into your investment, and it looks like a tenancy in common. Okay. Jay, how was that? Was that good?
That was
30,000?
great. That was great. Are you ready for a few questions?
I think so. Yeah.
Okay. Sir, I don't think there'll be any curveballs.
Let's go. I
Not
can hit
kidding.
those.
Tana, did anyone ask a question in the chat?
Yeah, I don't see any.
Okay, well, so what are the additional hurdles or risks to the syndication group, and conversely to the TIC investor?
So for the syndication LLC, it's a good question. So for the syndication LLC, you actually own less than 100% of the property, right? So if your tenant in common owns 10% and you own the 90%, the revenue to which your syndication LLC and thus your limited partners are entitled to is less, right? So you have to account for that in your offering documents. You need to say, hey, you're no longer acquiring the property. You're acquiring a 90% interest in the property as tenants in common with your 10% TIC investor. Okay, so there's a couple of nuanced sort of compliance things that that you're best to adhere to. Outside of that, because we concentrate so much of the administrative responsibilities in the syndication LLC, ultimately it's going to be run very similarly to a normal offering. Now, I will be honest, and I don't want to talk you out of anything, but I have had some operators come back and they're like, you know what? I don't think I'm ever going to do a TIC again. And look, I'm not an operator. I create all your documents, and then you go have a day. Yeah, you go put your portfolio together, and and I'm here for that. So it leads me to believe that number one, they have a CPA who doesn't like them. Okay. And they say, hey, this is weird. What do I do? I've never really handled this before. Okay. And so they're passing along that stress to the syndication LLC, and they're like, wow, my CPA doesn't like this. And so I don't either, kind of thing. Okay. Or two, maybe there's something more that you have to do. Nothing's really jumping out at me, but I think it really is come tax time. You've really got to hack up your balance sheet and your profit and loss at the property in proportion to the tenancy in common. Okay. Now that doesn't strike me as something onerous, right? But maybe it is. Okay. So all in all, my perception as a legal advisor is there's not a considerable burden to the syndication LLC. There's an extra cost, of course, that goes into that, right, as part of the closing process. But what's another couple grand, right? So outside of that, going to the tech investor, what's the risk there? Well, what I advise and what has been vetted, if you will, through a number of top CPA firms, right? And we like them because they know the Rev Proc, they know the Internal Revenue Code, they know the revenue procedure laws. And so when they sign off on a structure, that gives me the confidence that I'm preparing the proper documents and advising on the structure properly. Okay. And so ultimately, you cannot. All right. So let me zoom out a little bit. In normal syndications, we have a 70, let's just call it a 70-30 split, right? Which is the middle of the fairway. 70% we reserve for the limited partners, 30% we reserve for the general partner where the sponsorship is. Okay. You can't do that with a TIC investor. Okay. You can't be their GP. You can't be a member of their company. All right. You're precluded and restricted from becoming a partner of theirs in their entity for 2 years after their exchange. Okay. And the reason for that is you can't just join people's entity where they're getting this benefit of tax deferral, or people would probably just be leapfrogging and jumping in and out of entities, and it'd make it extremely difficult for the IRS to really pinpoint who the beneficiary of these, tax benefits is. Okay. And so it begs the question, well, how does the sponsor get paid on a TIC investor's TIC? Okay. And so you have to be their manager. You have to manage their LLC. And I don't mean like member managed. This is a manager managed LLC. Okay. And so you're not a member of it. So you're like, all right, well, if I'm not a member, I don't get any distributions. How do I get paid? Well, you get paid as the manager in 1099 income. Okay. That's pretty big. So let's chalk one up. Let's chalk a negative up to the TIC investor in that, wait, I lose management of my own LLC. Yes, you do. And let's chalk kind of a demerit or a loss up to the syndication LLC, because now the sponsor is getting 1099 income. That's a ordinary income tax is ordinary income tax revenue. Whereas capital gains, flows from membership interest. So it's really important to note that the larger your TIC investor is, conceivably, the actual bigger dent in your carried interest and promote you're going to get as the sponsor. Because if they have a higher TIC percentage and you're managing their entity and getting 30% of the net profit, but it's paid in 1099 form, a larger swath of that income that you're anticipating in your investment as the sponsor is going to be dinged by that ordinary income tax treatment. I'm not sure, because I'm not a CPA. I don't even play one on TV. Okay. But I'm not sure about uh, depreciation and all of that, if you can offset it when you're 1099. I don't think you can, because normally depreciation is handled in K1s. So what you could conceivably do is you take the manager of the syndication LLC, and Jay, this is probably the answer you envisioned before you asked the question. But you take the manager of the syndication LLC and you make it the same manager as your TIC investor LLC. It's the same thing for liability purposes. But also, if that's the case, then you could reallocate some depreciation over to that manager to possibly compensate for the hit that you're going to take in ordinary income on your payments, as in the 1099 form on that TIC investor. So we kind of weaved in and out, but we kind of had to. But those are some of the pros and cons, mostly the cons of the tenancy in common.
So that's a lot more information in that answer than what I expected, and I'm going to have to go back and listen to the recording to even pretend like I understood what you just said, but it is being recorded, so we'll do that. To encapsulate everything you said and to go back to the beginning when you said that you have had some GP groups come back and say, I'm not going to do that again. It seems to me like the very most important thing, if you plan on pushing forward into this, is to make sure that the CPA understands everything that you're hoping to do and endorses that and then collaborates and communicates with you before you ever actually attempt this.
Well, so that it brings short answer is yes, I agree. But to expound on that further, there's a lot of things that you need to do ahead of just committing to the tenancy in common. You need to ensure that this TIC investor, okay, number one, fills their form out right and identifies their property properly. Okay, things of that granular nature. But you need to make sure they're okay with you being the manager of their LLC. Okay. Some people are like, whatever it takes, I don't care. And some people are like, no, no way. I would never let you do that. You're gonna steal my entity. I mean, people say anything. Okay. And they're justified in feeling that way. Now, obviously, you have an operating agreement that expresses and describes what the relationship looks like and the certain rights and responsibilities, but you need your CPA on board and ensure that they understand. You need your TIC investor on board and make sure they understand. Okay. About the allocations of depreciation, about maybe you're taking more money and carried interest from them. Maybe you're taking 40% from them. Okay. And then ultimately get some sign off, because I didn't want to take the conversation there, but I'm going to touch on it briefly. There's something called a swap and drop, which is where you can swap the property. So they do their exchange, do their down leg. Now they're ready for their up leg. That's the purchase. Okay. And then they fold that TIC into the syndication LLC. Normally, I recommend doing that at a refinance. So it's where somebody exchanges, you establish the tenancy in common. Jay, you check all the boxes that we just talked about. CPA's on board, TIC investors on board. Everybody knows what's up. We buy the property as tenants in common. Now we get to a refinance, and you're like, hey, listen, we don't want to be a TIC anymore. We need to dissolve and just be a single borrower LLC. So the IRS doesn't call really balls and strikes on folding that TIC then into the single borrower. Really, the impetus is just that you're taking title to the property at the time of exchange, but there's no real hold period or anything after that. But it does say that if you try to use it as some way to improperly avoid tax liability, that it could be used against you. But if you think about it, doing an exchange is an intentional way to get around paying taxes. It's in the code. Okay.
So doing that, interjectorally here, so doing that drop in conjunction with a refi somehow is seen as more legitimate by the IRS than if they were to just on day two drop their TIC into the what's my terminology here, into the entity that's the GP.
Into the syndication LLC.
Yeah.
And then you just put them on the cap table, and now the syndication LLC owns 100% of the property. So everybody's diluted a little bit by virtue of absorbing that TIC investor, but economically, the needle never moved, because now the syndication LLC is entitled to 100% of the income instead of just 90 as previous.
This has been a great informative session, and this is really a lot more information than I actually thought we would get. It's been great.
I don't know how to answer things simply. I've never asked my wife. I just can't do it. So
I have a simple question. I think this is pretty simple. Just timeline wise, how long does an investment property need to be, first of all, like held to be eligible for a 1031? And then how long does the 1031 investor have to identify where they're putting that money?
Yeah, so there's no like whole period requirement, and that was my point a moment ago. Once you swap, how long do you have to hold it for? That's not a thing. How long do you have to hold it for even initially? There's no requirement there. So a lot of people do exchanges when they're particularly when they're inside what would otherwise be a short-term capital gain window, which is like a year. They'll do it to try to avoid that ordinary tax treatment.
Okay. I kind of thought with a smaller multifamily, I thought you had to hold it for 2 years before you can 1031 into another deal. Is that right?
Not
necessarily.
I haven't seen that. I don't know if there is that hold period. I
Okay.
don't know if there is that hold period. Now I can't point to the Rev Proc that says like there's no hold period, but I can't point to one that does say that. That could be the case. But again, I've never had a seller that I've worked with and I've represented a lot of sellers that have exchange, and I don't think that their hold period has ever come up. It's usually the change of ownership and things. Now there is some limitation as to how many of these exchanges that you can do. That's a little bit more on the CPA side, frankly. Um, but yeah, I don't think there's a hold period timeline before you're eligible, if that's what you're asking, before you're eligible, to exchange your property. Yeah. And then what was I'm
So
sorry, what was the
yeah, and the
second
next
part?
question is like how long do you have to identify the property that you're going to 1031 into?
So what people often try to, you only have a 45-day window after your closing within which to identify your properties. Now, this is fun, and we're not going to go into granular detail on this, but there's actually about 3 ways that you can identify in a combination. So you can do 3 properties and you can close on any one or more of those. If you do more than 3 properties, you have to close on either 95% of them, or there has to be some percentage of 200% of whatever. Okay, there's like stuff that's confusing, but normally it's just people are prospecting as they start to get in the sale process and possibly even sooner. They're starting to vet opportunities to do their exchange because everybody feels like 45 days is 45 minutes. They're in pure panic mode when they sell their property because they're like, I mean, I get emails all the time from brokers. They're like, I have a 1031 buyer. Like, send me a property now, kind of thing. Okay. I mean, I literally got one like 15 minutes ago. So 45 days to do the identification. Look, if you fudge something in your form and you misidentify or you put the wrong percentage or you put the wrong exchange amount, I mean, you can really hurt yourself once you get outside of that 45-day window. So provide yourself up to 3 options initially. You really only want to go past the 3 options if again you can do the 200, you can't do more than 200% of something, or you have to buy 95% of the properties that you identified, which is really weird because if you only do 5 properties, what is 95%? I always thought that was a weird rule. Um, so yeah, 45 days.
Hey, Nick, this is
Oh,
really
and then
easy.
one last thing. Then you have 180 days from your closing date within which to complete the transaction after you've identified. But here's the crazy thing. Last thing. Sorry, Jay. My understanding is your QI, even if you identify either too few properties or you don't spend all of your money, they hold all of your money that you don't spend for the full 180 days. So you're not like, all right, I'm good on the 2 properties. Once you send my $300,000 over here, like they hold on to it for 180 days and then they release it to you. It's really pretty crazy. I think the exchange agent does that as a requirement on their side. So that's it. So know what you're going to do, know your identification so you don't lose the benefit of your money for 6 months while it sits at a QI, probably maybe accruing interest for you. I don't really know. But yeah.
So it's
So Nick,
45 days to identify and then 180 to close.
Yeah, but the 180 is not from the date you identify. The 180 is from your sale date when the funds were initially sent to the QI.
Okay.
So it could be 135 days. I just did math. From the 45th day, if that's when you identify.
Okay.
here's a simple, potentially last question. And the answer is a simple number expressed as a percentage. So, but I'm going to phrase it as a story problem. So once you get your syndication attorney understands what you're trying to do, you get the CPA understands what you're trying to do, and then the TIC investor understands and opts in for the investment, you still have to get the bank on board. And on a percentage basis, in the last year or two on transactions like this that you've been involved with, what percentage of banks actually understand and ultimately say, yes, we can do this?
I have more that say yes than understand it.
Okay.
But yeah, I mean, bankers, they're a fun bunch. I nearly all are okay with it to some extent.
Okay, so
Agency has some limitations. You can do it in Fannie and Freddie. You have a limitation. I think it's 8. It might be 10 tenants in common, which is like, I don't think I've ever done more than maybe 4, something like that. I mean, the juice has got to be worth the squeeze, to be honest with you. So, just be sure that your tick investor prospects are not ticking in with $50,000 and they got 0.89% of the property or something like that. I mean, it needs to be, fairly substantial in light of your raise. HUD will not allow a tenancy in common. And so the rub now there's also, I don't know if you guys have caught wind of this tax abatement stuff in Texas. Has anybody heard of any of that stuff? The traveling
no.
HFC, stuff like that? Yeah. So there's something that you can do. It's like a housing finance corporation where you have some rent restrictions on your property. And by doing this, it's a state statute and you can actually avoid your ad valorem and real property tax. And it requires you to actually deed the property to this HFC that then establishes a lease, a landlord tenant sort of relationship. So you can't do a tenancy in common there because the HFC has to be the sole title holder there. Yeah, and then just running into inexperience and ignorance on the lending side. And I mean that just in like they don't know it, they're not comfortable with it, and then they say no. I have people that aren't comfortable with it at all, and they're like, oh, okay. And then they have their attorney review the documents that I prepare, and they're like, well, it says what he said it will say, and so we're good with it. Um, the issue becomes the nice thing is that normally your tick investor, that tick LLC, not the non-syndication, of course, it's going to be a borrower, but so will your other tick. The tick investors LLC will be a co-borrower. If you're the manager, generally they won't underwrite that tick investor because some people are like, well, I exchanged, but I got a bankruptcy 3 years ago. I don't want to be underwritten. You're like, yeah, I don't want you to be underwritten either. And so there you want to serve as the manager. And that helps keep the control chain, occupied by you, and then you're really the only one getting underwritten. And so that consolidates it for the lender. If they're like, wait a second, you manage this one and that one, okay, I can get on board with that because I'm basically dealing with only one sponsorship or one party. Very rarely, but it happens, but rarely do I see not only the tick investor getting underwritten, but also having to be a guarantor. Okay, it can happen. It depends on the bank, and if they say it's a requirement, then it's exactly that.
Jay, I got a question. This is John Bartley.
Hey, John.
Um, Little background, qualified intermediary for the last 20 years and also real estate and title attorney.
Sweet. Can't wait for this question. All right.
Well, I got a couple. I've already, just from your description, I wrote this question down early, but I feel like I know the answer, but I'm assuming that most of these TIC investors are just going to be single asset LLCs for the investor.
They'll have to be in most contexts. So what we'll do is first I ask the TIC investor that I'm like, hey, does this LLC that you're basically exchanging with, does it own other property? If they say no, then you're good because you just represent that it doesn't. And so it is that single asset entity. Otherwise, we create that disregarded LLC that's owned by their exchange LLC, and then they get the whole single asset checked off.
I was assuming a single, wanted to confirm. On the operating, or that, I can't remember your term, but functionally the agreement between the TIC LLC and the Syndication LLC.
TIC agreement.
TIC agreement, okay. Typically, is that TIC agreement going to be recorded in the public records?
And no, it should not be. So we'll do a memorandum of TIC that puts the world on notice, really a subsequent lender, that a TIC agreement exists, but the contents of which are not made public record.
Okay. And would that TIC agreement, I'm assuming that would have some sort of restrictions on conveyance of that undivided interest.
So it does, but remember, we're going, so yes and no. Like it by statute, yeah, like there's like it's an undivided interest, and so there's really no partition, kind of sale type verbiage. But here, giving the TIC admin the authority that it gives it, at least in my documents for purposes of the syndication, it contemplates the TIC admin making the decision on behalf of the tenancy in common to sell the property as tenants in common, and kind of puts in a drag along right to the extent the TIC admin wants to sell. The TIC investor has to go along with it. Scrupulous TIC investors could put that it has to be at reasonable value, or some have put that so long as they capture their basis. You could even have a fund or a pref equity or somebody do a tenancy in common, and then they want, a threshold even above that in terms of certain pre-identified returns. But normally we're not dealing with somebody that sophisticated.
I was even thinking the other direction of limiting the TIC investor from being able to sell off.
No, oh yeah, it definitely restricts that transfer.
Okay,
I'm sorry, I took it the other way, but yeah, they can't do anything. So they have, there's a tenancy in common is statutory law, okay, but ultimately all of it can be modified by contract, and that's what we're doing with the TIC agreement. Is we're modifying, because we don't want the state statute speaking on the relationship. We want it to speak, we want the agreement to speak on that. So we restrict that TIC investor. But remember, if you manage their TIC LLC, it's you anyway.
That logistically, that makes a lot of sense there.
Yeah.
Last question. This is coming from the 1031 and the QI perspective. With a taxpayer selling, if they need to claim some debt with the asset they sold, they had debt paid off, they've got the cash equity to invest the cash, but to get the full tax deferment, they either need to inject additional cash or replace the debt. How would that, if they needed to replace a certain amount of debt,
it just has to match the leverage. Well, go ahead. Sorry, John.
I was saying, if there is debt involved in the acquisition by the syndication entity, I'm guessing it would just roll back to agreements with the lender of how much they would allocate to syndication and how much to TIC investor.
Well, remember, they're co-borrowers. So it's the property that's collateralized. That collateral in the security deed of trust, mortgage, deed of secure debt, whatever instrument, whatever state we're in, is what is being pledged by that's encumbering the property itself.
Right.
And so ultimately, I mean, I haven't drilled down so far because that is a little more CPAE kind of exchange agent question. But normally we try to match the leverage. It comes into consideration. But a lot of times I kind of get the sign off from the TIC investor, like, hey, make sure you're good. When you come in, here's what it looks like. Occasionally, I kind of jump in to say, hey, here's where I kind of pare this thing down. And then we present that question ultimately to the exchange agent that TIC investor is using. Because a lot of times they have access to their own sort of internal counsel, particularly some of the larger shops, where they can say, hey, here's exactly what it needs to look like. And then they can proceed knowing what the loan program is that we have, et cetera. But it's generally proportional. Actually, I don't think it is proportional. I think it's with respect to the property into which they're exchanging, ensuring that there's the equivalency of leverage.
Yeah, thank you.
Generally, I wish I could answer that one a little bit more clearly, but like I said, most of the time that TIC investor is going to work with their QI on that to get that particular leverage language clarified.
Hillary, are we good here? This has been super powerful. We're very grateful to you, Nick. You knew that this would not take 20 minutes when I said that it would take 20 minutes.
Yeah,
you knew, and you were right. You were right again.
I know these things. I do these all the time, and I really enjoy them. I really do.
Right.
And I've enjoyed this. This is a good.
We appreciate it. I'm sure we could go on for another 40 minutes, but let's respect your time.
Who wants to pay for that?
Thanks for doing this, Nick.
This was a lot of value. Where can they find you, Nick, if someone wants to get in touch with you?
Well, geez, 30% of the people on here are my clients, maybe more. So you know where to find me. Click that retainer button. But outside of that, you can find me on LinkedIn. It's really the best place to connect. If I've gotten to know you for a while, that's when I kind of add the Facebook thing. As I get more publicity, I find that I get more requests of people I don't know, and then I have this like paranoia that all the people on my feed are going to be people I don't know. And so, ultimately we'll probably get there and, friendship, but just LinkedIn is good. Email, and then, I mean, JD, I mean, I'm responsive. I mean, he and
Yeah.
I, text, whatever. Jay, same thing. So I'm accessible, but yeah, initially LinkedIn's really good. That way we can, have some faces there, and then certainly email. And my email is easy. It's nick@rfllplaw.com. I can throw that in the chat real quick as well, just if you guys are going to continue on.
And Nick's the best attorney, is really easy to get a hold of.
Thanks, JD. That was not a paid advertisement, guys.
Thanks, JD.
He volunteered that.
I get a referral fee, don't I?
Yes. Yeah, we'll work it out.
Just kidding.
I mean, you pay me. I mean, yeah, I'd have to discount because you're the one paying me. So yes. Yeah. Always. But yeah, JD's got some really good stuff. We've got some tick stuff that's coming down the line, and we're getting some questions answered there and getting them comfortable with the process. And so that's exciting. So he'll have some stuff to chat with you guys about. And if you guys end up talking shop on those things, and we need to jump on a call to clarify anything, I'm happy to do that. But appreciate the time, and yeah, reach out if you need me.
Thanks, everyone. Have a great evening.
Take care, guys.
You.
Happy
Thank you.
Thanksgiving.
You too.
See ya.
Likewise.